The beginning of September normally marks the end of summer for many and often ushers in a period of increased volatility in global markets. It certainly feels as if September so far this year is sticking to that script. The tech-heavy Nasdaq was up an incredible 80% from its lows in March, late August, but has since dropped by 10%, with individual stocks like Tesla losing as much as 34%, Apple down 20%, and Microsoft down 12% from the recent highs. Now, even after the dramatic fall in Tesla, it is still up 358% so far this year, so we have to keep the recent drop in context. However, financial press last weekend was full of stories unmasking SoftBank as the Nasdaq whale that had bought billions of dollars worth of equity derivatives that stoked the huge rise in August and arguably contributed to the just as dramatic fall in September so far. We must remember here also that the global stock markets have become increasingly divorced from the global economy, so it's not obvious that the recent equity drop is telling us anything new about the macro outlook. However, the sharp rise in volatility has coincided with several risk triggers. Congress has returned from a short summer vacation in the US. An attempt to pass a slimmed down version of the fiscal support package failed in the Republican-controlled Senate this week, suggesting the chances of any fiscal support ahead of the November election have dropped very sharply. The news came on the same day that we saw a larger than expected rise in initial jobless claims in the US, suggesting that the sharp improvement in job picture through May to August is slowing more sharply too. We've also had other sources of volatility injected into markets too. News that a participant at Oxford University's AstraZeneca vaccine suffered an adverse reaction triggered a voluntary pause, adding to the sense that the pathway to a widely available commercial vaccine is still fraught with issues. And the 8th round of Brexit negotiations between the EU and UK got off to a terrible start this week, given news that the UK intends to publish an internal market bill relating to Northern Ireland by the end of September, which the EU suggests undermines the Brexit agreement that is in place. Meanwhile, Trump has continued US-China decoupling moves, and the next hurdle markets will need to clear is the September 20 deadline that was imposed by an executive order on TikTok owner ByteDance. ByteDance has warned that it is increasingly likely to miss the deadline for the sale of US operations after new Chinese regulations complicated the issue. Now, our view here is that we should expect to see more volatility in global markets in the weeks and months ahead, with the run-up to the US election in November set to be a huge event risk with very binary outcomes for markets. Global market volatility has also had an impact on markets here in Australia. The ASX is still well short of highs seen in February and down 3.5% so far this month. Following the previous week's trade above 74, which was the first since August 2018, this week saw the Australian dollar dip below 72 cents as US tech stocks tanked. However, the domestic economic news was better this week, with consumer sentiment roaring back despite official confirmation in the survey week that Australia had experienced its first recession since 1992. The rebound means the index is now just 1.6% below the average over the 6 months prior to the emergence of COVID-19 in March. The other piece of good news came in China August trade data that pointed to demand for iron ore being almost insatiable. China's August imports were the third highest on record, with the previous months being June and July. In the last 3 months, Chinese imports are up 20% year on year, and Chinese imports in the last 3 months combined equate to 100% of Brazilian and Australian exports. No surprise then that iron ore prices hit 7-year highs late last week. Now, next week brings several important risk events to monitor. The LDP will elect a new leader in Japan. We also have important China activity data for August, which I'll be watching very closely for further signs that the very sharp recovery in Chinese activity continued well into Q3. However, the biggest event will likely be the FOMC meeting outcome Thursday next week, which may reveal less dire 2020 GDP and unemployment scenarios, given that they were more pessimistic than the market mid-June, and the rebound since then has surprised on the upside. But the Fed will continue to harbour concerns about reduced fiscal support and the path of the virus. Fed Chair Powell may even flag the prospect for opportunistic reflation, which could include upping the QE pace if inflation shortfalls persist in coming months. This could tip the US dollar lower next week and thus help the Australian dollar. Here in Australia, we have August employment data on Thursday, and following the release on Tuesday of weekly payrolls data, we've revised up our forecast for the outcome from minus 75,000 to minus 50,000. These are all factors we'll talk about in next week's market update.